Now, before I go there, let's see accounting. The word accounting, basic meaning of accounting. Accounting means we are providing information for decision making. That's the simplest definition. So, at the basic level, we were told that accounting is what? Collection of what? Financial data, analyze them or process them to meaningful information and present it to what? The users for decision making. That's great. Now we have the basic stages in accounting. At the intro section, we normally call it financial accounting. Financial accounting. And I believe all of us have has that paper. Great. And then the second, that's at level 1. The level 2, we call it what? Financial reporting. Financial what? Reporting. That's great. Financial reporting. Great. Now, at the final level, that's the level 3, we will call it what? Corporate reporting. Wow. Corporate what? Reporting. That's the advanced financial reporting. That's the corporate reporting. So you should know the stages. As accounting is moving higher, it is increasing in difficulty. The same thing happened to nature. As things are getting intense, then it increases in what? Complexity. The same thing. So at the intro level, financial accounting is not that difficult. Financial reporting is a bit higher and the corporate reporting is higher. So that is it. Now, financial accounting simple means records keeping. Records, we are going to keep what? A basic set of records. So for records keeping, so bookkeeping, that's great. So the financial accounting level, you were told or you were taught how to keep a basic set of what? Records. So as we said, in financial accounting, you should know how to keep basic set of records. So such as the day books, and then there's posting purposely for the double entry bookkeeping. So that's the records keeping. Then after the financial accounting, after a successful completion of financial accounting, you'll be graduated to what? Kind of offer financial reporting. Now, what is financial reporting? Financial reporting. Now, here I use 2 words to describe financial reporting or to explain financial reporting. Financial reporting simple means preparation and presentation of financial statements. So, preparation and presentation of financial statements. So it means that at the end of this subject or section, you should be able to prepare a basic set of what? Financial statement. Prepare and what? Present it to the users. So financial reporting simple means preparation and presentation of what? Financial statement. Basically, that's what it talks about. So that's great. Now, what records are you going to use to prepare the financial statement? Is a record kept by the financial accountant. We pick it, summarize it, and present it to what? The users. We cannot just pick the records and present to the users. No, it will be voluminous and it will be void for its purpose. So we have to summarize it in a financial statement, just like 5 to 6 pages financial statement prepared, then we present it toward the users. We are done. So that is it. So have you seen the stages? At the first stage, keep the records. Second stage, summarize it and present to the user. What about the last stage? The last stage, you see it here. That's the corporate reporting. That's extremely complex. Now, corporate reporting talks about three items. Basically, it talks about your financial, your social, that's the people, and then the environment. Basically, corporate reporting consists of what? Your financial reports, first thing. Second, your integrated reporting or the integrated reports. It talks about how you create value. How you create value. So, value creation, how the organization creates value. So, it basically talks about everything about the organization, corporate as a whole, your financials plus how you create value. Now, how value is what? Created. Great. Now, the integrated reporting, it includes reports like chairman statement, the corporate governance style, ethical stand. All these reports will form part of what? The integrated report. So if I add the financial report to it, I have what you call the corporate reporting. That's what we see in the annual reports and then at the AGMs, calls for discussion. So basically, you know the levels of accounting. At the last stage, it's a bit complex, but you'll be fine. The issue is that if you understand this one very well, this will be a bit easy for you, and this one will be a bit easy for you in that order. It's like a building your dream house on a solid ground, or building your dream house in a sand. Imagine. So that is it. So please try and understand this one very well so that the corporate reporting at the final level will be okay for you. Now that we know that financial reporting, we are doing this. This is where we are now. So we are going to prepare financial statement. We are going to what? Prepare and present financial statement. So at the end of this chapter, make sure that you know how to prepare and present what? Financial statement. That's great. So basically, that is it. When you go to level 3, still you prepare financial statement, that's the corporate reporting, and we add the other reports, integrated reports, you add chairman statement, directors report, corporate stand, then corporate governance stand, and then the ethical stand. A statement must be issued on your ethics. That is it. Now let's go to the financial reporting. That's your paper, and then you'll be fine. Great. So now let's single the financial reporting and then we just do to it. So financial reporting. Now the topics in it, according to the syllabus, the new syllabus, the topics are not many. They are not many. You range from 5 up to 6 topics, and then you'll be fine. They are not many at all. 5 up to 6 topics, you'll be fine. So I'll list the topics for you, and then list the marks, and then the target marks. The first topic, so let me do it this way. So the topic will be here, and then the marks, that's the weight. Marks that we've allocated. And then here is the target. Target means what I must let you score in the exams. So if you score higher than that, then you've done well. But I'll let you pass gently, nicely like that. Now the first topic on the list is the conceptual and regulatory framework. The conceptual and regulatory framework. Now they've added ethics and ethics. Ethics. Ethics to financial reporting. So the max is 15. is going for 15 marks. So that's the marks assigned to it, 15. Out of the 15, don't worry, score what? 10. Yeah, that's the target marks, 10. So that's the first topic that we should know. It's basics, concepts. So when you are learning on your own, you should be able to understand the conceptual and regulatory framework of financial reporting and ethics in financial reporting. So conceptual, regulatory framework, and ethics in what? Financial reporting. That's the very first topic. Second topic, that one talks about the financial reporting standard. That's the IFRSs. Financial reporting standards. Financial reporting standard. That's the second one. Now with this, with the financial reporting standards, from range from five of the standards, and the max is 25 marks. The max is what? 25 marks. Now please here, score 19. No, score 9. The max is what? 25. Score 9. Don't score plenty. Score 9. Great. Now let's see the third one. The third one talks about the publication. The publication. That's the final account, the preparation and presentation of the financial statement, the final account itself. So let me write here, final account. That one is 20 marks. Yes, final account is 20 marks. Here they do well and score 12 for the examiner. 12. So obviously the target marks, not plenty. Yes, it is strategic. It's strategic. So that is it. Now the fourth one is consolidation. Consolidation. That's consolidation. With consolidation, the max is 20. But target max is what? 14. Score 14 for the examiner. Yes, that's the target max, 14. The max is 20. Consolidated statement of financial position and then the profit or loss. So that is it. And then you'll be fine. Now, for ratios, the last one is the ratios. So it means that your topics are 5. So ratios, that's the interpretation of financial statements. That one too is 20 marks. But here, just score yourself 12. Give the examiner 12, not plenty. Great. Then let's see the overall or the total marks. So putting all together, here the overall marks will be what? 100. Let's see the target. So 10, 9, 19 plus 20, 12. So the target is what? Just be adding it. If your own is ready, just let me know. You can type it for me. If your target marks is ready, you can type it for me. Great. Good. So let's continue the game. Now kindly add for me and let's see the target marks and the actual marks. The actual marks supposed to be 100 because we marked over 100. And let's see the target marks, the marks that you should score in exams. You should score in exams. Great. Okay. Now let's see. So we are adding 10 plus 9, 19 plus 12, 31, 31 plus 14, 31 plus 14, that's 45, 45 plus 12, that's what? 57, right? Great, you pass. So 57, that's the total target. So this is what everybody must score, 57. 57 is the target mark. So that is it. So now that we know the target mark is 57. In fact, 57 is it's okay. It's okay. So now let's work hard for it and then you will be fine. So that is it. Now this is the journey and this is the issue before us. So let's try as much as possible to work them out. Yeah. The only issue is the IFRS. Please and please again, make sure that your understanding of the financial reporting standard are what? Okay, are great. Other than that, you face a little challenge. The financial reporting standards, you meet 5 out of 17, you meet 5, and that 5, they will team out to give you 25 marks. Out of the 25 marks, you can score just 9. At least in 9 out of 25, which is a bit far, but that's the target marks. Although I know that you can score more than what I'm saying. Yes, more. So you can score more than 14. Ratios, you can score more than that. So that is it. Great. So that is the journey. Tonight, I'll start with the very first one, the conceptual and regulatory framework of financial reporting. That's where our kick can start from. Now, the material will be uploaded onto the platform, and then you get a material. It contains questions, and then try and then familiarize yourself with the question for me. Now, before I continue, let me list the materials that you need for this program. Please, these materials, to ensure a successful pass, get these materials on board. Get these materials on board. So for financial reporting, here are the reading documents. The material that you need to get. One, the first material is get a study text or the study manual. The study text. I mean the ICAG study word text. Go, the ICAG study text. The ICAG study text. A second. Kindly get the both new and then the old. New / the old. But I like the new one. Then the second material that you have to get is the question bank. Question word bank. That's the new ICAG question bank. Then the third one, the handouts. That's the notes that I'll give. All the handouts. And then the last one, that's the fourth one. The fourth one is what? The past questions. Past word questions. So to ensure successful, these 3 are for practice, and this one is for the principle. You are done. Make sure that you get these books before next week. Yes, before next week. Make sure that you get this book. Get the study text. If you don't have, draw my attention. Yes, get a study text and then you'll be fine. Okay, let me go straight to today's agenda and then the very first topic of the syllabus. Then you are fine. Now look at the conceptual and the regulatory framework of financial reporting. The conceptual. and the regulatory framework of financial reporting. Conceptual and regulatory framework of financial reporting. I'll be very fast here. So conceptual and what? Regulatory framework. Regulatory framework of financial reporting. FR. Please, no shortcut in exams. No shortcuts in exams. So conceptual and regulatory framework of financial reporting. That is the first topic. In fact, it contains ethics. We've added ethics to it. So ethics part of it. So here it made it up of three strong topics. Conceptual framework, and then the regulatory framework, and then the ethics. So kindly bear notice of it. It's going for 15 marks. Definitely there must be a question on this topic and you'll be fine. Now let's see how we do justice to it. Now we know that the word financial reporting means preparation and what? Presentation, the double P. Double P. Preparation and what? Presentation of financial statement. That is financial reporting. So when somebody is preparing financial statement and presenting it, the guy is doing what? He's reporting. Don't mind the guy. The guy is reporting. Good. Now, if you want to prepare and present financial statements, there are some basic concepts, ideas, assumptions, principles, phenomenon, practice, assumptions that you have to adhere to. You can't just start and say, I'm preparing financial statements, so you just put revenue together, profit together, you are done preparing. Put anything together to represent what? Something. No. There must be concepts. There must be basic principles. And there must be what? Rules that form the basis of financial reporting. So that's it. So the conceptual framework basically talks about the principles, the assumptions, the basis that you must adhere to in preparing a financial statement, or that form the basis of financial reporting. So if you want to prepare and if you want to prepare financial statement, make sure that you satisfy yourself with all the principles. And these principles are called, they are stated in the conceptual framework. Now, these conceptual frameworks are given to us by a group of professional bodies, but given to us by a board called International Accounting Standard Board. So normally we give reference. So we normally call it ISB's Conceptual Framework. So that is it. Now we call it ISB Conceptual Framework. Why? Because these principles, these basic assumptions are given to us by who? The board, the ISB. So that is it. Now, the main responsibility of this board is issue the IFRS. Wow. The IFRS, that's the main responsibility of the board, to prepare and issue the IFRS. Aside the conceptual framework, it means that this is the principle. In fact, I call the conceptual framework personally the principal bank. Principal or bank. So it's the store that contains or that stores the accounting principles or concepts or ideas. Great. So that is the conceptual framework. Now, the conceptual framework and the IFRS are not the same. Bear in mind that the principle is not the same as the law. I mean, this is the law and this is the principle. They are two things all together. Just that the principle is what other than the law, right? Great. So That is it. Now, the IFRSs, the requirement of the IFRSs supersede the conceptual framework. If there was a contradiction or the requirement of one conflict with the other, the IFRS supersede the conceptual framework, even though the conceptual framework is what older than the IFRS. Yes, that's great. Now let's see the basic purpose or the objective of the conceptual framework. Now, why do you think the ISB, International Accounting Standard Board, will put together these ideas, these assumptions, these basic principles to guide what financial reporting? What is the purpose of the conceptual framework? That's the next one that we must know. Purpose of what? Conceptual framework. So purpose of the conceptual framework. So conceptual framework of financial reporting. What is the purpose of the conceptual framework? Now, you realize that the conceptual framework is given to us by who? The IASB, right? The International Accounting Standard Board. Meanwhile, their sole responsibility or their main agenda is the IFRSs. So you say that, but before they form the IFRSs, they have to consult what? The conceptual framework first, before they come out with the IFRSs. So here, in a way, we can say that the conceptual framework assists the board. So one, it assists the board. Assist who? The IASB. IASB. That's great, not the other way rather. IASB. So assist what? IASB to one, develop IFRS. So to develop what? Future IFRS. Develop future IFRS. Or in short, develop what? Develop IFRS. Now, to develop IFRS is both future and the update of existing one. So if ISB want to come out with a new IFRS, they will pick principles from where? The conceptual framework, from the principal bank, before they issue the new standard. However, if they want to update existing IFRS or they want to revise existing IFRSs, they go through the same. They also have to now consider the conceptual framework for principle. So in a way, the conceptual framework assists the board to develop IFRS. Don't forget that both future IFRS or to update existing one, today's own. I'll be getting it. Great. Now, two, it assists the board to promote what? International harmonization of the IFRS. That's the second purpose of the conceptual framework. So two, to promote what? We already have the two there, so let's continue to promote. To promote international harmonization of the international harmonization. Good. International harmonization of the IFRS. International harmonization of the IFRS. That is the conceptual framework. So the conceptual framework help the board to sell the good news about the IFRS, and a lot of countries, institutions, corporations adopt the IFRS. In fact, the conceptual framework help countries or other institutions to adopt the IFRS by limiting the alternative treatment of accounting transactions. If you like, give one transaction and call 100 accountants, all of them will give you what? Different treatment. But the conceptual framework limit that or prevent that. So in a way, it brings what? Standardization and then being harmonized, That word. Now we also have this is the first set of what the purpose. We can also talk about the other. So it also assists the following. It also assists the following people. So the other. So this is the first one, A, and then the B. If we can also say that assist who? Assist the following people. So what are they? Assist the following. What are they? So let me lay them down here. Then you tell me. One, it assists users. That's the first body. Two, it assists what? Preparers. Preparers, right? Those who prepare the financial statement, the conceptual framework assists them. Then the third people is that national standard setters or accounting standard setters. The national standard setters, standard setting body or setters. Then the IV, it also assists what? Auditors. Oh yes, my people. Auditors. Auditors, great. So that is it. Now, these four people, tell me how would the conceptual framework assist them? Users, for instance, how would the conceptual framework assist the users? You know, it helps the users to interpret the financial statement, be able to make their economic decision or make the informed decision. So you get that, right? Yes, the conceptual framework will assist the users. Great. What about the preparers, the CEO for consultants, those that prepare the financial statement? It helps them to prepare what? The financial statement informally. What about the National Accounting Standard Setting Body or National Standard Setting or setters? You know, each and every country have a national standard setting body. So national standard setting what? Body. This body set the accounting standard for the entire country or the nation wide. So that is it. Now, what do you think will be the purpose? You know, they will make sure that their local standards or the national standard match up to the international standard, which is the conceptual framework. So in a way, it serves as a benchmark that the national accounting, accounting standard bodies look up to. What about auditors? The last people, auditors. The conceptual framework helps the auditors to make their audit opinion, to form their audit opinion. How? How will the conceptual framework help the auditors? One, there's an adage that if there's no law, there's no crime. So when auditors come, they are just going to check whether the financial statement that you prepared conform with the reality and agree to all relevant laws and regulation and principles. The principles are what? The conceptual framework. So when they come, they check whether the principles in the conceptual framework, you've got it right or wrong. That's all. So if there's no conceptual framework, auditors find it difficult to tell you whether what you've done is right or wrong. Have you seen that in Ghana, because there's no law covering motor riding, they cannot prosecute any Okada riders. Good. So where there's no law, there's no crime. So that is great. So this is the purpose of the conceptual framework. Now let me walk you through a few challenges that we have with the conceptual framework or a few difficulties with the conceptual framework. Few difficulties with the conceptual framework, and then you will be fine. Few difficulties or limitations with the conceptual framework. Few challenges with the conceptual framework. So limitations of what? The conceptual framework. of financial reporting. So what are the challenges that we have with the conceptual framework? The challenges that we have with the conceptual framework, the challenge. What do you think will be the issue? These principles putting together, what will be the challenge? What will be the limitation of this conceptual framework? The first one that we will talk about is this. Have you seen the users of financial statements? The users, there are many, right? Shareholders, owners, employees, auditors, preparers, management, loan creditors, suppliers, customers, government authorities. All these users have a what? Different what? Needs. All these users have a different needs. So one set of principle might not be able to provide what? All the needs of these users. So in a way, it serves as challenge. So the limitation will be that it provides general meaning. It failed to provide specific needs of a user. I'll be getting. So it failed to provide what? Specific. It does not provide specific need of a user. Why? Because the users are many. One principle, accountant use it. One principle, the one who wants to audit use it. One principle, customers are using it. One principle, who again? Shareholders are using it. One principle, who again? Tax authorities are also using it. Then it will not provide specific needs. We don't have shareholders, their own principle, not at all. We don't have conceptual framework for shareholders. We don't have conceptual framework for accountants. In fact, the same principle now is being used by the ISB, the International Accounting Standard Board, the one that set the standard himself, the one that bring the conceptual framework, he himself now also use it, right? So in a way, it does not provide specific needs of user. It does not to provide specific need of user. And the second challenge that we have with the conceptual framework is that when transactions become complex, the old principle can no longer what? Apply. When transaction becomes what? Complex, the old principle can no longer apply. When transaction becomes complex or the business expands and increase in complexity and things become what? Too complicated and sophisticated, the old principle can no longer apply. Let me give you an example. When we are like this, we're operating only in Ghana, maybe only in Accra, some part of Accra. Now we're operating all over the country, all the 16 regions, we are there. All the 16 regions, we are there. Can the old principle no longer apply or govern us? No. Formerly, you are one place. What if now we are, let's say, operating all over Africa? Then it means that we have increase in complexity and risk. So the old principle can no longer apply. I have one example, a real life example that I always cite it. So let me cite it here too. Yes. The first one go like this. When everyone is young, probably you're the one that doing some of the responsibilities. Yes, traditionally, African law, traditionally, when you are young, you're the one that probably small sweeping, small washing of both, small like cleaning, good. Now, when you grow up and you get married and you visit your mom, probably the younger siblings there, and mom inform you that go to the kitchen and go and wash the both before coming up to greet her. No. Why? Because now you are what mature then. Now your things are what complex, right? Your transactions are complex. But if you go to the house and your mom can still go and tell you go and wash the both, it means that your transactions are still what? Simple. Probably the one that paying the bills, probably she's the one that paying the fees and taking care of your accommodation. So that is it. Now, a critical example is this. In the house, you tell the what or everyone or the children that as soon as you eat, wash the bowls. Do not leave the bowls there. And this particular children. He is not feeling well to the extent that he cannot even walk. He's lying down. You are the one that fed these children. After eating, do you expect the guy to go and wash the bowl? Not at all. Why? But it's a principle in the house that when you finish eating, you have to wash the bowl. But why is that this guy, like worrying him to go and wash the bowl? It's because things are now what? Complex. The transaction is what? Complex. It's not simple. So the old washing bowl cannot what? Apply here. That's great. So that's a few challenge that we have the conceptual framework. So as and when we are increasing in complexity, now the old principle, the more the principle are what? Doing what? Fading off, right? Great. So that's why there must be a need to update this principle each and every time. Now I'm done with the intro part of the conceptual framework. Now, the conceptual framework is like a book or pamphlet. It's a book or pamphlet that contains a list of principles. So we are going to look at the content. It has 7 contents. 7 content for our studies. 7 word contents. And then we're going to look at all the content. In fact, all the contents are examinable. All the contents are examinable. All the contents are examinable. So take note. All the contents are examinable. Content number 1, it talks about the objective of financial statement. Objective of what? Financial statement. Now, the question is, we are learning how to prepare and present financial statement. But before we prepare, we should know why we are preparing the financial statement. Have you seen? So what is the main reason for the preparation? Why do companies prepare financial statements? Why do entities publish their financial statements? Is it to show off the kind of asset that they have or the kind of properties that they have? Then, if not, then what is the main purpose? The objective. I wish they give me a chance. We can reframe this question back to the level 2. Yes. I'll start like this. Great. I'll start like this. Makola Uma does not prepare the financial statement, right? Yes, Makola Uma does not prepare financial statements. But other entities prepare, companies prepare, right? Good. So why is the main purpose? Don't tell me that to know the profit or to know the performance. For profit purposes, go and ask the Makola woman. She can tell you all her profit since the one that she started the business. Yes. So that is it. Now the main aim is to provide information. So the main objective is what? To provide information. Like we said, accounting. The main aim is to what? Record, provide information. So to provide what? Information. Most often with a company, most often the management and the ownership are in different hands. Different people managing it. Different people are what? The owner. So the ownership and management are not the same. So you own a company, someone is managing it for you. At the end of the day, you expect the person to furnish you with what? With some set of what? Information about the company. Tell me what's going on because I'm not the one managing it. Yes. So that's the main reason for the preparation. So the main reason for financial reporting is to provide information, report certain information out, tell the users what's going on. Makola woman or a sole trader does not prepare financial statement just because she's the one managing the business. She's the one owning the business. So she does not have any accountability, responsibility towards anybody. So everything is in the mind. So no financial statement preparation. And then you'll be fine. Great. Any question? Now, the main objective is to provide information about what? about the company. Tell us what has transpired for the 12-month period, January to December. Tell us. Now the question is, what type of information you are going to provide? Specific information. I think there's a question. So now, the main objective of financial statement, the preparation, is to provide information about the company.
Okay.
But like, not necessarily that to know your profit. For the profit motive, even if you don't prepare financial statement, you can assess your profits. But when you assess your profit, you know it alone. The management team know the profit alone. The one managing the business can determine the profit alone. It's okay. But when you determine the profit, what do? Share it with us because you're not the one, you're not the only user. So the main motive for the preparation and presentation of financial statement is what? It provides information. Great. Now, let's see. So the main objective is not to determine your profit, show off your assets, or you have the biggest asset or the biggest profits in the company. No. But to tell the other people what's going on, the information. So even the profit that I'm talking about here, we are going to still stipulate it in the books. We are still going to talk about it here. So what type of information are you going to tell them? So that's the first question. We are going to provide information about the company to the whole world. Yes, or to our users. Great. What type of information are you going to tell them? So the first information or the first thing, tell them about your performance. Your performance. And most often, the performance, which financial statement are you going to assess your performance? You're going to use your profit and loss, your P&L. So your profit, box onto the profit. Even though the profit is not the main aim, you are providing information about your performance. How we get it? Great. So you are going to provide information about the performance of the entity. You're going to tell the whole world our performance for the year. Great. 2, tell us changes in equity, effect on your equity. So the effect on equity, that is changes in equity. Great. The third one, tell us your financial position. The financial position. How we get it? Great. Now the fourth one, tell us the cash flow position. Cash flow position. Great. Cash flow position. So these are the information that you're going to tell your users about the company. So these are the information that you're going to display to your users. How we get it? Great. So that is it. Now let me ask this question. How many times do entity have to prepare financial statements? How many times do entity have to prepare financial statements? How many times do entity have to prepare financial statements? Yes. Any idea? The company's Code or the Companies Act 2019, Act 992, states that at least you prepare financial statement once a year. At least the least one must be one, right? So you can prepare as many as possible. So for instance, someone can decide to prepare what? Prepare 1, 2, 3, 4, 5, 10, 20, 52, 365, and many. Yes, say at least what? One. So the least one must be one, but there's no limit to it. But the issue is this: cost benefit analysis. If you get the money and use all the money to provide information, then it will reduce your performance or your profits. So the issue is that the cost involved of preparing the financial statement must not outweigh the benefits. So if you're going to prepare many as possible, don't forget that the preparation cost too will also be high. If you consider the auditing cost alone, when auditors are coming around once, look at the amount that they are charging you. And now you see you're going to prepare, let's say, just 10. They are coming 10 times, audit fee 10 times in a year. You'll be in trouble. So even the smart entities, they prepare 4, and then out of the 4, they publish just the final one. So they publish just the final one, and then they upload the interim one. They upload the quarter financial statement. So first quarter, second quarter, third quarter, fourth quarter. They upload it onto the company's website. They are done, and then auditors will come and audit the final financial statement, putting all together for the year. Yes, because if they should audit all these financial statements, the auditing cost will be high. Don't forget that the publication cost, you have to publish it in the newspapers. Buying a stand in a newspaper is not an easy job. Yes, an amount that you incur for it. So even though we are saying that we are liberty to prepare as many as possible, we shouldn't forget that the preparation cost you also limit us. And then, so most companies prepare it once a year. Now we are learning how. We are learning like the principle behind the preparation, so that when we start preparing the financial statement, we know what we are preparing. Not we are just preparing financial statement. We know the number of times, and we know the issues surrounding it. So this is the conceptual framework. Now you should know the users. For users, I'll do it here. It's in financial accounting, so you've done it. You should know all the users of financial statements and their information needs. If you don't, please revisit the books and then get them back. You'll be fine. I write them on the board. You should know what they need. We have the owners, one. In fact, let me even mention them. Owners or shareholders or investors. That's one. Two, management team. And then the third one is what? The employees. Fourth one is the suppliers, customers, and then the next one is what? Loan creditors or lenders. Government and its agencies and the general public. These are what? The users. Those that the organization's activity affects, or they have interest in organization directly or indirectly. You can also call them what? Stakeholders. In management studies, we call them what? Stakeholders. Yes, they are stakeholders. Please don't confuse shareholders with what? Stakeholders. Okay, don't confuse shareholders with stakeholders. Thank you. That's fine. Great. So I'm done. Now let me go to content number 2. There are 7 contents. So content number 2 talks about the underlying assumptions. The underlying assumptions. The underlying assumptions. Now, what are the underlying assumptions? Now, the underlying assumptions, that's the accounting concepts. There are a lot of accounting concepts. You can give me some. At the financial accounting level, you learn them. Okay, Alain, there's a question for you. Great, underlying assumptions. Now let the question flows. Let the question flows. The underlying assumption. Now, the financial statement that we are going to prepare, it must be based on the accounting concepts. And these accounting concepts, there are many. As you know, in the financial accounting level, they are, you can list them: prudence, consistency, reliability, dual, money measurement, accrual, matching, going concern. Oh, mention periodicity. Oh yes, the one you mentioned is also part of it. No, the one you mentioned is a characteristic. So somebody mentioned faithful representation. It's a characteristic. I've seen. Great. Now, these assumptions, we have analyzed some of them. We have accepted some of them that it must form the main basis, the main root, the main basis, the main. So if somebody say I have underlined it, okay, write something and underline it. Okay, I have stamped it, agreed, accepted. Aside all the standard or all the assumptions that we have, some of them has been what accepted to be the main one. That even if they are not there, don't prepare the financial statement. How do you get it? If those ones are not there, don't prepare the financial statement. Yes. If those are not there, don't prepare the financial statements. Just come back home. If you go to the exams and then if you guys are going to write the exams and you go, it's financial reporting paper. They start Arabic and they start the language there. It's in Portuguese. The financial reporting writing is in Portuguese. You write, just stand up and come back home. Portuguese. We didn't teach you Portuguese. So what do? Just stand up and then come back home. That's not the underlying assumption for examination. Our underlying assumption for examination is what? English. It will be in English, right? Great. So with the help of this understand, let's bring it here. Now the financial statement, the assumptions are many. So the main one is one, going concern. Going concern what? Basis. Going concern basis. So it means that the financial statement must be prepared on going concern basis. That's the main assumption. It's the main one. Even though I'm going to give you underlying assumptions, the going concern is the main one. I'll explain why. Now, going concern, what does this statement state? Or what does this concept or assumptions state or assumed? The going concern assumes that the entity that we are preparing the financial statement for will continue its operation for more than one accounting period. He will survive into the future. He will live for more than 12 months, right? Great. So the going concern suggests that the entity will what? Will live to see the future. That's the basis. So that's the basic underline, or that's the basic assumption. How we get it? Great. So it assumes that the entity will live to see what? Future. The entity will not collapse within the next 12 months. So at the basic level, we define going concern as what? So this states that the accountant should assume that the entity will continue its operation into what? The foreseeable future. Future is unknown. Like you're not going to collapse now. That's the understanding. You're not going to do what? Collapse now. You are going to live, or you are going to operate for more than one accounting year. You don't know when you are going to collapse. That is it. That's the going concern basis. And it's the main one. Because the financial statement, and even here, auditors have to assess it. So after you prepare your financial statement, auditors will assess your going concern, whether you can be in business for the next 12 months or for the next 24 months. Agreed. Great. Now, it's because of going concern that we have to balance off the account and close the books and carry the balances forward. So we have something we call closing balance. So closing balance. So if you know that you live to see tomorrow, whatever you eat today, please leave some for tomorrow. Close the balance, leave the remaining ones, the leftovers for tomorrow. Let's assume that you don't live to see tomorrow. Let's say today they tell you that someone tell you that tomorrow you don't live to see tomorrow. What do you do? If you're going to spend all your money that you have today, right? You are not going to even send anything tomorrow. Let's say you're going to travel. You are traveling, you are not coming back to Ghana. You are traveling for maybe a tour, 2 years tour at let's say you are going to Dubai. You are going to stay there for the rest of your life. That we don't have going concern in Ghana. Great. So will you leave anything in Ghana? Not at all. I won't even leave one person. You carry everything straight to Dubai and be there, right? Great. So it means that if you know you live to see tomorrow, close the balance, send it forward. And that's why we have what? Open balances. Open balances. Open balances. Open balances. Great. The open balance and the closing balance is because of the going concern. I will live to see tomorrow. However, if you know that you don't live to see tomorrow, then don't use going concern. Use what you call the other one, the other assumption, just that it has not been underlined. The other one. Use what you call breakup basis. Breakup basis. With the breakup basis, it means that we are going to collapse. We are going to wind up. So the account, that's the end of that's our last financial year statement. Because we are not going to live to see the next 12 months. So we don't need to carry any balance forward. So that's why we have balance carry forward. So the closing balance is what? Carry what? Forward or carry down. And then this one is what? Brought forward and brought down in that order. But over here, the breakup basis, you don't have something like carry forward or because you don't live to see tomorrow. So what are you carrying forward? Yes. So that is it. In fact, I think that's the main reason why God not tell anybody when you will die, because other than that, you consume all what you have. You don't leave any good testimony. Any nothing for the children. Yes. So that at least God will wait when you get a lot of money, then probably take you away and then the children will enjoy it. That's great. Okay. That's the going concern. The second assumption. But the assumptions are two. But the one that they've underlined is what? Going concern. I'll even explain. The second assumption is what you call accrual basis. Accrual what? Accrual basis. Basically, it's the same as the matching concept. Matching. Obviously, matching where expenses must match against the year's revenue. Great. So that is it. So matching what? Concepts. Great. So accrual basis. Now, I have a nice formula where I want to give the formula. But when they mention accruals, don't worry yourself. Just write recognized or recorded. Or record must be equal to what? Occurrence. Yes. That's the formula that I want to quote for you. Recognized is equal to what? Occurrence. Or recognized is equal to occurrence. Then you are done. Or recorded or record is equal to what? Occurrence. Now, accrual concept simple means when you are preparing the financial statement, record or recognize transaction as and when they occur. The word is as and when they do what? Occur. When it is happening. When they occur. So record all transactions that has been what? Occurred. Not what? Not when cash has been received or what? Paid. So that is the accrual basis. You know, the matching concept states that if you want to determine the year's revenue, cost must be matched against revenue and vice versa. Or revenue must be matched against what? Cost. Of course, if you want to determine profit, you match all your revenue, that year's revenue against what? That year's cost. Then you determine your what? Your profit. Now, accrual is saying that the revenue that you are going to match, it must be those that has occurred. So revenue that has occurred, cost that has occurred, but not the one that you've paid for or you have received. So according to accrual is just saying that the expenses that you have consumed, please record them, whether you've paid for it or not. So from January up to December, all the expenses that you have consumed, please record them. Whether you have what? Paid it or not, it must be in the financial statement. Revenue from January to December, all those that you've earned, whether you have received the money or not, what do you do? Record them. So that's why it's because of accrual. That's why an inventory is an asset recorded on the balance sheet. If not, inventory will not be on the balance sheet. Why? Because accrual is saying that revenue must be matched against what? Against the cost. So then let us record the cost of the inventory on our balance sheet until when we sell it, then we match it in the revenue. So it means that anytime we sell that goods, it will be removed from the financial position as a cost, and then we present it as an expense in the cost of sales. That's why inventory is what? Cost of sales. At the same time, it's an expense. When you are matching it, you match it in the P&L, and then you record it as an asset until it's being sold. So that's it. Now let me explain this. Now the accrual basis is a subset of the going concern. In fact, the underlying assumption is only one, is the going concern. Out of the belly of the going concern flows the accrual concept. Why? Now, if you know that you don't live to see tomorrow, you sell on credit. Let's assume the accrual basis, you've made a sale of 50,000. Out of this sale, 40,000 is on cash, and then 10,000 is on credit. Accrual, you're going to record all the 50,000 and accrue the remaining portion as what? As a receivable into the future period. But if you know that you don't live to see the future period, will you sell on credit? Not at all. I won't sell on credit. Look at what happened when the COVID came. Most organizations were selling on cash. Why? Because they suspect that when you buy and go and collapse, they will face difficulty. So they will not sell to you on credit. Most of the organizations were selling on cash. Yes, that is it. So it means that the accrual is part of going concern. So indirectly, the underlying assumption is what? Only one. What is the going concern? I am done. So in exams, when examiner asks you what are the underlying assumption, only one, singular. They are looking for the going concern. Maybe if they ask for two, the underlying assumption, then you bring the accrual in for them. I'm done with the underlying assumption. That's the content number what? 2. I'm done. Let's go to content number 3. Content number 3. Content number 3. But what I read is coming from the paragraph 12. Content number 3 talks about the qualitative characteristics of financial statements. So qualitative for character, right? Characteristics of financial statements. Now, the financial statement that we are going to prepare, yes, both in exams, so please, what you are learning is not only in reality, both in exams, apply them in exams. The financial statement that we are preparing, it must possess some qualities, some attributes, some features. If it to be a disease, we thought that this disease comes with the symptoms. But financial statement does not come with the symptoms. It comes with what? Qualities or features. Agreed. Good. Now they told that COVID, if it needs plenty, then COVID is calling you. If cough plenty. In fact, could you imagine that since COVID came, I've never coughed? Whenever it's coming, I have to kill it before it comes out. Other than that, if you cough 1, 2, 3, they'll call the quarantine teams for you. Great. So that's the attribute. Now, qualitative features. The financial statement that we are presenting to the users, or the information that we are presenting to the users, so that they can base on it and make decisions. It must possess what? It must possess some qualities. What are they? The qualities, we have grouped them into two: fundamental and what? Enhancing. So first, we have the fundamental. So fundamental qualitative characteristics. Fundamental qualitative characteristics. Then we have what? Enhancing. 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 But I'll talk about the fundamental first before I go to the enhancing. So there are only two: enhancing and fundamental. Just that the fundamental have two, enhancing four, or making six. We are done. Now let's see. The fundamental are only two. Why do we call it fundamental qualitative features? It is fundamental qualitative features because it makes the financial statement useful. Any quality, any attribute, any feature that make the financial statement the best, or make it what? Useful. Make the financial statement useful. That feature is, you are what? You are fundamental. That means most of the financial statement must possess this attribute before it can be what? Useful. What are they? The first one I'll talk about it is what? Faithful presentation. So the first one under the fundamental is what? Faithful representation. Please, you can be called upon to explain what is meant by what? Faithful representation. You can be what? Called upon to explain what is meant by faithful representation. So take note. So faithful representation. Representation. Faithful representation. Now, what do you mean of faithful representation? The financial statement must be what? Faithfully represented. Here, in simple quotes, simple term, the financial statement must represent what has actually what happened, must represent the reality of the entity. I agreed. The financial statement must represent the actual transactions, not what the managers or the management or the directors think they should have gotten, right? Great. So the financial statement here, we are saying that the financial statement that we have prepared must represent the economic reality. Economic what? Reality of the entity. Of what? The entity. Economic reality of what? The entity. The financial statement must represent. So if I'm preparing the financial statement or the information I'm sending to you, that it must conform with reality. It must conform with what? Reality. It must conform with what has actually happened. Not what we think, oh, not manipulations, oh, not cooking the books, oh, not changing figures, not changing figures, not big bath accounting, not massaging. That is it. Now it means that if you have recorded assets in your financial statement, that asset must what? That asset must qualify according to what? The recognition criteria of that element. So whatever you have included in it must qualify or must have an evidence or evidential, must like actually represented, or must be the reality or the actual. Somebody said that, like, you know, the online, one thing about the online classes, most of us said that, no, Fred, I want to see you physical, actual. So yes, you will see. But it's so that the online is not the economic reality, but it's a reality. So not the online version, here they want the actual version, the physical version, not the soft copy, hard copy. That's what they want. Actual. Yes. Someone will tell you that photocopy is far better than original. Yes, that was someone who said. So that is it. Now, to report faithfully or to represent faithfully, before the financial statement be faithful, there are some ingredients, I call them what? Ingredients. Or there are factors that enhance the faithfulness of the account. So to report faithfully, the following things must be in place. One, the financial statement must be what? Complete. So to report faithfully, one, the financial statement must be what? Complete. So one, the financial statement must be complete. So let me start here. It must be complete. The financial statement must be complete. To report faithfully or to represent faithfully, the financial statement must be what? Complete. That's the first ingredient. Assuming that you have 5 cars, five trucks, 3 are doing well, 2 in terrible situation. In fact, all the engine collapse, everything. In fact, if you decided to add the details of the 2 to the other 3, making the 5, it will waste the whole show and it will render the organization, in fact, give the organization a big shame. So what do? So you decided to report only the three that are doing good, the one in the good state, or the one in the good shape. In fact, you are not representing faithfully. Why? Because the transaction is what? Incomplete. You have 5, you're talking about 3. Have you seen? You're hiding them, right? Great. Then, to report faithfully, the remaining ones, no good. As when I say them, probably you put it down. Then probably put it down for me. So sorry. Or I'll clean the top. To report faithfully, the transaction must be what? Neutral and unbiased. So neutral or what? Unbiased. Neutral. Be fair in your judgment. Select fair accounting policies. Accounting policies that provide fair judgment. Accounting policies that are what? Neutral. I hope you get that. So select policies that are neutral, and then you are fine. You know, some of the accountants, because their fat bonuses are being tied to profits. If the transaction will bring profit, you see them taking their long pen and accounting for it, everything, because they want to blow up the profit. However, if the transaction will lead to a loss or an expense, all what they'll do is they will just let's leave it there. Let's leave it there. In that order. Or they will select accounting policy that will let them overstate the profit. You are being what? Biased. That's not what? Faithful presentation. Have you seen? In fact, we are working through all this so that when we start the preparing of the financial statement, you won't do the same. Have you seen? Great job. Then the third one is that to report faithfully, the financial statement must be free from what? All material errors. That one I write. Must be free from where? All material errors. Material what? Errors. That's the third one. To report faithfully, the financial statement must be free from all material. It must not contain mistakes. Here we are not saying that you are Angelo. Some of the mistakes or errors are pardonable, other ones are not pardonable. Yes. So that is it. In fact, some of the mistakes, they are intention. An intentional mistake are what? They are fraud. How we get it? They are intention. Oh, let's do it. They will not see. When they see, let's tell them that it's an unintentional, it's like a mistake. Oh, let's not, we didn't see, we didn't notice. Oversight. No, you know what they are doing. Like most of the banks, always the system is down. Everything. In fact, when I'm going to withdraw a lot of cash or maybe huge amount, of that the system is what? Is down. Everything, they're hiding behind the system, right? Yes. Even if they are late or still the system was down. Even the late comers, still the system is down. That is it. Now let's move on. Now the fourth one, in fact, it's dry. Without it, there's no faithful presentation. And most examiners like it. They've asked it before. It was asked in November 2018. November 2018, exactly 2 years to today. They've not asked it again. Exactly 2 years when you're going to write your paper. That's great. The fourth one is what? To represent faithfully or to report faithfully, the transaction must be recorded on the share substance, but not the form. So substance over form. On their substance, but what? Not the form. So record the transaction at their substance. The economic reality of the transaction must be recorded. So transaction must be recorded what? At the economic reality or the substance version, not the form. Yeah, let me explain this because it's a very topical issue in financial reporting. And your examiner asks it. And I'll ask the same question after today's version. That's November 2018. Go and check. Question number 5. Question number 5. The last question in that sitting. The last question in that sitting. Formally, it was the last question. Conceptual framework is the last question that we asked. So it was either question 5B. Yes, question 5B. Formally, the question 5A was the capital partnership and then the branch account and high purchase. The specialized accounting transactions, good. So that is it. Now let me take time and then explain substance over form a bit later. What's the meaning of substance over form? Substance over form. How many size of accounting transactions? Each and every accounting transaction, how many size? This is the second stage of accounting, so I believe strongly that you know, right? Most people thought that there are 2 sides of accounting, right? If it's not debit, then it's what? It's credit. Let's see. If not debit, it's credit. Okay, in fact, each and every side for accounting have 4 sides. It's 4, not 2, not debit and credit. There's extra one there. You are going to learn the extra one today. For the debit and credit, yes, you know them. There's extra one there, right? Aside the debit and credit, there are also 2 sides of every accounting transaction. They are the one you are going to learn today. That's great. So we add it to it, making what 4. Don't worry, you'll be fine. Now, for every accounting transaction, there must be legal form of it. Legal form. You know how I call it? If I let me write it on the top so that I can get, let me start writing on the top so that I can get more space. I can get what? More space. Now, here will be okay. Let me go up. Okay. So I call it what? Legal form. Legal form. Personally, but I call it a package. Package. I don't mind the package. Mind the content, right? Yes, package versus what? Content. That's great. Now let's see. Hey, let me see you. Great. Now let's see. We have the legal version of every transaction. And then we have what? The economic reality. Economic reality. Or we have what? The substance. Substance. I call it what? The content or the actual. The content or actual. So every accounting transaction that takes place or that we record in the books have to, aside the debit and credit, it also have these 2 sides. Tell me any accounting transaction and let's tell you the legal form. Let's say, example, you are there. You walk to a shop and you buy an item. So purchases. When you buy purchases, they'll tell you that debit the purchases account and credit what? The source. If you pay with the cash, you credit your cash, right? If you didn't pay, what do? Then you credit what? That supplier, right? So whatever be the case, the other section is the credit. Great. Now, that side is on its own. When you buy item from a shop and you pay and they give you the item, let's analyze it. What's the legal form? Legally, who owed that item? Legally, who is the owner of that item? They've transferred ownership to you, right? Thank you. So legally, you owe the item. So legally, ownership is that you owe. So there's what? Ownership. Yes, it's for, I've paid for it, so the item is for me. Let's see. In reality, who controls the asset? In reality, who will use the asset? Who will benefit from the asset? That goods that I bought from the shop. I'm going to use it. So I control. So record. So it means that it's for me. The benefit will flow to me. The economic benefit will flow to me. Ownership, I'm the one that owing it. So record. Have you seen these transactions? Both the legal and the substance version are the same. There's no difference. Legal is saying you are the one owing it. Economic reality also saying that you are the one going to use the assets, or you are not going to use that item that you bought from the shop. So it is for you. So record it. Ownership is also saying that, oh, legally you own it, so you record it. So there's no difference between the legal status of that transaction and what? The economic status. However, not all transactions are like that. Some of the accounting transactions, their legal state is materially different from what? The economic state or the reality of the transaction. How we get it? So let me give you an example. I've not defined substance over form. I'm explaining it and give you the principle behind. So let's give examples of substance over form transaction. Transaction that legally they look different from the economic reality, from the actual content. They are also different. Everything. It's like forest. If you like stand afar and look at forest, you thought it's just like one tree, one big tree, or the trees are the same, like they are like closer, giving that nice shade. Now get close to the forest and you see the reality that the trees are far away. They are all far. They are not close. How we get it? So that's the legally and what the economic reality. Great. Now let's give this transaction examples. So examples of what transactions that have legal form. That their legal form is what different from what economic reality. Finance lease. Finance what? Lease. I hope you know lease, right? Lease. Long renting. Maybe we want to use a particular equipment or a particular building, a particular machine. The machine have 50 years, but we don't have the money to buy the machine. So what do? Let's go and rent it. At least annual rental payment there we can pay, but buying the machine outright there we cannot pay. Yes, that's one of the banks. I won't mention their name. They even lease their head office. That is it. That's great. Now, let us know if we rent the machine for, let's say, 45 years. We are renting it for 45 years. For lease simple means long rent. In accounting term, we call it lease. How we get it? Long rent. That's great. Now, when you lease this machine for 45 years, let's analyze the legal state of it and then the economic state. Legally, do you owe the machine? We have leased it. We want to use it, but you don't have the money to buy, so you are renting it. So legally, is it for you? Not at all. No ownership. So legally, no what? Ownership. So legally, no ownership. How we get that? So legally, we don't owe that machine. Legally, and if you don't owe that machine, what do? Don't record. So no recording. No recording. So don't record. Yes, you don't owe. Don't record. Now let's go to the economic reality. Tell me who is using the machine? Is it us or the owner? We are using the machine for 45 years. It's a contract. You can't come and take it from us. So we are using for 45 solid years. Meanwhile, the machine life is 50 years. So who is the asset? The company, right? That's the leasing, right? Us. So we are going to use the asset. And once we use the asset, what do? We control the asset. And once we control the asset, that means we what? We enjoy the economic benefit, right? The economic benefit. So the economic benefits, that means all the benefits will flow to us directly. It will not go to the owner because the building, we are using it. In fact, it's like buy these expensive cars and get a SUV driver. For the driver will enjoy more than you do. Why? But he is controlling the steer, right? Those expensive cars, when driving it, like even from where I sit inside though, have you seen? Look at how I said it. We are sitting inside. Have you seen? Some of the car you sit inside, some of the car you sleep inside. Have you seen? Have you seen the difference? Great. So the one who controls, here we control the assets. The benefits flow to us, so we are going to enjoy the assets. Good. In accounting, the one that control the asset have the right to record it. That's in accounting. In what? Accounting. The guy that have control over that asset is the one that have right to record it. In accounting, oh, great. So it means that here record it. Hey, too trouble. Just one single transaction, one side record, one side no recording or don't record. So what do? Are you going to record or you? So here, whatever the substance says, so the substance must outweigh what? The form. So we call it substance over the form. So here I'll record it. So that's why finance leases are recorded on the balance sheet as what? As assets. So here it must be recorded. Don't mind this. So whatever the substance says must outweigh what? The form. And we call it substance over the form. So the requirement of the substance must take into consideration. Why? Because the substance is the reality. This is the reality. Everybody sees that you are the one using the asset. And you are telling us that you are not using the asset. Everybody see that you are the one that moving with the person. Everybody see you. Just that legally, if not, how do you call it, come together. And now something happened now. You are telling us that you know nothing. You know nothing. They will put the legal matter aside that legally you've not seen her. But they will come to reality. But because in reality, you are the one controlling the assets, they will come for you. I'll be get it. That's great. So that was the example. So now let me define substance over form proper with this illustration. Now substance over form, they are situation or transactions that have their economic reality materially different from what? The legal form, in which the economic reality been recorded or recognized. We only record. It's a principle that states that the substance version of a transaction must be recorded, but not the legal form. That's a substance over form. This principle states or requires that accounting transactions must be recorded on what? On their substance, but not the form. That's a substance over form. Now, please, know 5 examples of transaction that give rise to a substance over form. I'll try and give you 3. The remaining 2 are yours. Please add it to it. That year, I did the same thing. Those who look for it, they enjoy in the exams. In fact, they call and testify. If you do the same too, you will enjoy and you'll be fine. You will smile. So the next example that I'll give is example 2. But example 3 will blow your mind. Example 3 to blow your mind. Example 2 is high purchase. High purchase transaction. High purchase transaction. It will move in line with finance lease. High. You hide the item before you buy it. Have you seen high purchase? You hide the item before you buy it. High, like renting, the same as renting. Now, high purchase is an agreement where you pay for some goods in installment, right? But meanwhile, you start using it whilst you are paying for it. However, until you finish paying for all the installments, and if up to buy it, the goods is not yours, the item is not yours, you don't have the ownership. So that's why when you fail to buy, so when you fail to pay for all the installment, they'll come for that item. Whatever you pay, lost. Yes, that's vanished. So that's great. How do you get it? So formally for the government workers, normally you see that they come around. Oh, come and buy. Come and buy. We take the money, monthly installments. If you fail to pay for it, they'll come for the item. Meanwhile, they'll give you the item once they are taking the money small, deducting the money small, spread the money. Good. So on that period, the asset, because you are controlling the asset, you send the asset to your room and start using it, especially television and then home appliances. You start using them. Sometimes the asset will even spoil. You don't even finish paying because the asset will even get spoiled. Amazing. You can't send it back. You have to close your eyes and do what? Pay all the remaining ones. So that's the example 2. Legally, you don't owe the assets, but in reality, you are the one using it. So you have to what? Record it in your books. So formally, in the old syllabus, there was a topic called high purchase transaction. But now it's no more in the syllabus. That's good news. So high purchase is no more in the syllabus. But at least it's still in it. Least is still there. That's IFRS 15. The third example, blow your mind. We call it what? Sale and repurchase agreement. Sale and what? Repurchase agreement. That's repo. Sale and repurchase agreement. That's repo. Here, this is the issue. You will sell certain assets. You will sell assets to someone. For instance, have an asset. I will sell it to someone, take money, and later buy the asset again. How? Let me give an illustration. Let's assume that I need 50,000 Ghana cedis right now. Right now. I need 50,000 Ghana cedis right now. Maybe the company needed 50,000 cedis to clear some goods from the ports. Maybe they've ordered goods from Atlanta, Georgia, to deliver the goods to South Africa, a client there, and take the money instantly. But the client in South Africa will pay for the goods only when he has received the goods, not when the goods has not arrived. But the goods too is at Ghana port before they will clear it and then transfer it again to South Africa. While the port authorities are demanding for 50,000, they can't get the money. When they use loan to the bank, it's telling them they have insufficient funds or they cannot request more than that their current loan. In fact, they can't take loans. So what do they do? Okay, good news. We have one good asset B, or we have some variable inventories. That inventory, we've stored it for long. It's like in the olden days, some of the families, when they are going to school, either your grandma or your mom have to go and sell one of his variable clothes. The cloth that she bought it at her youthful age, which has been kept for long, over 20 years cloth. You go and pick that cloth and go and sell. Why? Because you need money to go and pay your fees, right? Great. The same thing that we are doing here. You need money to go and clear goods. So what do? You go and look out for the most valuable asset that you have, that you know that this asset, if I say I'm selling it, a lot of people will come and buy. So I'll sell it for 50,000 cedis. So sell for 50,000 cedis. After selling it for 50,000 cedis, then I'll relax and tell you that, please, this asset, I need it. I need more than you do. I'm just saying because of the money. So please keep it well. Exactly 3 months later, I'll come and buy it from you at the price of what? 70,000 Ghana cedis. Exactly 3 months. I'll buy it at 70,000 cedis. However, keep it well. I will pay you extra 1,000 Ghana cedis per month. 1,000 Ghana cedis what per month for keeping the asset for me. If you know that you are going to use that asset, then I will not pay the 1,000 Ghana. I will not pay. Because how on earth will you use my asset now? She also be paying you keeping fee. No. Agreement is an agreement. Please, it's an agreement. It's an agreement too. You can't just find someone, sell something to you, and later you're going to buy from the person. The person to by the thing you showed it to me, why are you buying it back again? But here's an agreement. That's why the item you sold it below the prevailing market price and you bought it what at higher price to entice the person to sell. Within 3 months, you are getting 20,000 cedis. Or as what 1,000 Ghana cedis a month addition. So like this one is even more than men's gold though. Within 3 months, men's gold will give you 20,000 within 3 months. Not at all, you won't even do that. That's fine. Now the issue is this. Let's assume that fact give me stop assumption. Tell me the legal form. So what's the legal state of this transaction? So legally, is there any sale or there's no sale? I need an answer. Here, I'll pick an answer from everyone. I believe strongly that everyone are fully understood what you've done so far. So now, please tell me your answer. Legally, is there any sale or there's no sale? And proceed to tell me the economic reality. Whether there were sales, which of them is no sale in that order. And if you have any idea, you let me know. Great. I like the suggestions. They are very great. Now, let's see legally. The legal status of this transaction is that legally there has been a transfer of what? Of ownership. Yes, within a 3 month. Within a 3-month period. Within a 3-month period, there's a sale. Yes, there's a sale. So sale has what taking place. Of course, because you sold it 50,000, you transfer the title deeds to the buyer. So now now the owner. Now the buyer is what the owner of the goods. Until you buy the goods back. The buyer is what the owner. You're not the owner. You can't go for it too. Until you go and buy the goods back. How do you get it? So legally, there is a sale. Legally. However, in economic reality, how on earth can you sell something and still have the same item back again on your balance sheet within some few months? If you are not a professional circle boy or thief, have you seen? Like it's an illustration. For instance, I learned some Chinese lady came to circle, and then her iPhone 11 was stolen from her, and then he said he want to go and buy a new phone. And she said, no way, the phone that she's buying is her old phone. They said, no, this is a new phone. Not only the same phone now, so they pick her own phone and sell it to her. I said, so how we get it? So in reality, there's no sale. In fact, he has just dashed them money. He has just dashed the people money, right? Yes. So in reality, no sale. No sale. Why are we saying that there's no sale? Then if it's no sale, then what is it? What's that transaction? It's a loan. You're taking a loan from the bank. A loan. Treat it as a loan. It's no sale. Why? Because you've taken a loan of 50,000. A loan of what? 50,000. Promise to pay back 70,000. Paying interest at the rate of what? 1,000 Ghana cedis per month. Using your valuable asset or your inventory as what? Collateral. If you go for a loan from the bank, probably they'll take the details of the collateral. If you use your vehicle as collateral, a good bank will take your what? The vehicle, the papers of the vehicles, right? The ownership deeds or the title deeds from the vehicle, and then they will keep it. So if you default, count your vehicle gone. So they'll come and then one day you'll be driving and then they'll just stop on the way that the vehicle has been seized by this bank. Yeah. So in reality, no sale, because you can't sell something and just after 3 months, that item will be on your balance sheet. Yes, so that is it. Now in exams, your examiner will do this. The examiner will tell you that the company has treated the thing what as sale. So what do? You have to reverse everything back and treat it as what? As loan. That's all. So in exams for publication, the published account, the final account, the P&L, we will tell you that the company has included this 50,000 in his what? In his sales, and has accounted for the 1,000 Ghana in the administrative expenses or added to the cost of sales. So what do? You have to reverse everything and then treat as what? As loan. So that is it. That is the substance over form. I'll be getting it very well. It's a very topical issue. Now, let me give you a gist or a clue on how to suggest or how to determine whether this transaction is a substance over form transaction. Now, anytime you realize that one, ownership and control are in different hands, then that transaction is likely to create substance over form. Please, this question came in November 2018. Then after today, before Wednesday, make sure that you have satisfied yourself with that question and you cleared it. Because everything about the question, you've done it. It came. I think it was for 6 marks. And 6 marks alone is enough for 6 marks. It's okay. Now, how do you know that this transaction is what? A substance over form. Here we are not saying anytime ownership and then control are in different hands, it will definitely be a substance over form. No, that means there's an indication. So anytime you realize that the person owing it is not the person managing it or controlling it, then there's what? There's an indication that does not mean it is so. There's an indication that they may be what? Substance over form. So anytime you have that, there's an asset, but different person own it and different person manage it, or different person control the asset, then there's an indication that there must be what? Substance over form. That's one. Two, anytime you realize that there's a transaction, there's a sale, but that sale is not at fair value, it's not at the market value, and now is subject to a lot of agreement and conditions, that is what? There's an indication that there is what? Substance over form. So that one is talking about issue. Anytime you realize that there's what? A transaction, and in that transaction there's a sale, but that sale is not at fair value. That's one. It's not at what? Fair value. Maybe the car that you are selling or the inventory you are selling, the price, you could have gotten more than 50,000, but because you need money, you are cash strapped. You need money, 50,000 just now. Something that costs 150, you can easily sell it for what? 50,000 cedis. Because you need 50,000 cedis, you don't care. Because probably the profit that you can make afterwards is more than what you are losing today. Great. And in that transaction, it contains a lot of agreement. It's subject to conditions, such as keep the car for me, I'll come and buy it later. Subject to condition. It's not a straightforward sale. If you are selling, sell. If you are buying, buy. But where you are selling with condition, then it may indicate that the substance over form. How we get it? So there's indication. Then that's great. Then, anytime you realize that related party trading among themselves, then there's an indication there's substance over form. That's it. So great. I think I'll project that question for you, and then you take a screenshot of it, and that will be your first assignment. So let me project it here. That question, the question I'm talking about, that's November 2018 past question, question 5B, or the last part of question 5, November 2015. Please, if you don't have the past question, kindly get a past question. Let me know those who are not having it, and then you get it. So November 20, not 15, no. November 2018. November 2018. So November 2018 past question. November 2018 past question. So November 2018. That year was a nice year. I think it's this year. It's the one that they have the no, it's not about 2017. Let's go down. It's not about 2017. It's not about 2017 May. And Gambata. Asuna Bata and Gambata. That was the name of the November 2018. Santasi and Patasi. Which year is that? Santasi and Patasi. This one is Bantama. My save question 3. So let me see if is that one. Good. This one is November 2018. So let's go to this one, November 2016. Let's go 2018. 2018. Why are you? It's question 5B. So when I check question 5B, is there no? I think it's this question also. Okay, this one is May. This 2017. Oh, this one is November 2017. This November 2017 question. Let's go to November 2018. November 2018. November 2018. It's November 2017. Good. So the next year after this one, or November 2018, you get there. November 2018. Good. This is November 2018. This is May 2017. This is May 2017. So this is May 2018. So the November 2018 is a foreign setting. Yeah. So it must be this one, right? So let's go to question 5. Let's check if this. Yes, this is the question I'm looking for. November 2018. Let's go to question 5. Great. Question 5. Question number 5B. Because in the O syllabus is the last question. Please kindly take a snapshot of it and then you're going to do justice for me. I need a solution. I need the solution. Please start from here. So I need a solution to this. Take a snapshot of it. It was for 4 and 6, making 10 marks. First, required. Discuss the importance of the concept of substance over form. Describe 4 features of transaction that suggest that its economic substance may, didn't say must, may differ from its legal form. So that is it. So suggest 4 features. So kindly take a snapshot of it. Let me also take it. I'll upload it to be the first drop. The drop 1. Great. So now let's go back to the board and continue the game. I hope everyone took a snapshot of it. Great. So now let's continue the game. So now I'm done with the substance over form. Please, the substance over form drives the faithful presentation. To report faithfully, the transaction must be recorded on your substance, but not the legal form. So anytime the examiner is asking you substance over form, indirectly, the examiner is asking you for faithful presentation. That is it. Good. I am done with faithful presentation. Now let's move on. Can you take note of? And you'll be fine. The same year, 2018 November. The more question that I said was the one that about 80% of it dropped in exams the same year. And the same year, I gave the same question to them. I gave them 3 examples. Just look for the remaining one. Some of them did that. Some too did not. I didn't ask again. But when it was there, and then I was blamed. But today, I don't want to be blamed. So please, I'll give you more of them. So try and then do that. The second one, under the fundamental, we said that the fundamental, the first one is what? Faithful representation. The second one that we are going to look at for under the fundamental only 2 is relevance. So relevance. The financial statement that prepared or the information that we are presenting today must be what? Must be relevant. Okay. Must be relevant to the decision needs of the user. The financial statement that we are presenting, it must be relevant to the decision needs of the user. That is it. Great. Now, when you mention relevance, in simple code, it means that the financial statement must contain all the information that will help the user to make his decision. That's all. The financial statement that we are going to present, it must contain what? All the information that will help the user to make it what? His decision. For instance, if your boss probably asks you, or probably you send someone to go and then pick something for you, go there, pick these files for me, and the person brought maybe the files and said no, the other ones. That means the first one is not, it's not that the first one alone is not what, it's not relevant unless you add the other one to so that you can make decision out of it. How we get that? Great. So that is it. So it means that the relevant simple means the financial statement that we are presenting. Coming in. Great. So relevant simple means the information that we are providing, it must be able to influence the decision needs of the user. So it must do what? Influence the decision needs of the user. Decision needs. The decision needs of what? Of the user. That's the relevant information. How we get it? Great. It must influence or it must assist that user to make all his decisions. So if you present information to somebody and say that, oh, it's not, please add the other one to it. I think if you add the other one to it, it will be okay. Add like the relevant for decision making. I normally call this guy shaky or shaky. It means that provide information that will shake the users. That will make the users like, that will help them to make their decision accurately. That's relevant information. Great. Now, relevancy of information or the relevant information play 2 roles or 2 key functions. Why are you going to provide relevant information to the user? It will help the user to make 2 key decisions. 2 key decisions. Or the roles are 1, confirmatory. So confirmatory rule and what? Predictive rule. Predictive rule. So it means that the relevant information help the user to predict the future and also help the user to do what? To confirm the past. Confirmation rule and what? Predictive rule. So when they give you the financial statement, you look at it and see, okay, if today we are getting profit of 10 cedi, or then tomorrow we have to get like 20 Ghana cedis. That's for tomorrow. Don't worry. Tomorrow's financial statement will come. Then you have to confirm whether what you predicted is true. If they don't give you relevant information, it will not help you to predict or confirm this 20 Ghana. Then you have to predict another one again. That is the relevancy that we are talking about, or that's the relevant information that we are talking about. Great. Now, before you explain relevant, or before you know that this information is relevant, I have to include it. It means that we have to include all relevant matters, all relevant information. So the question is, how do you know that this information is relevant? How do you know that this information is not relevant? It all box on materiality of the entity. Materiality. So you cannot explain relevance without materiality, because materiality moves the relevance. What's the meaning of materiality? Let me start by saying this. There's a certain information, when you include it, shareholders will think different. The same information too, when you exclude it, they will also think different. The same information, when you misstate it, like it was 20,000, you make it 50,000 mistakenly, they also think different. Such information is what? Is material, and that information is what? Relevant. So all material informations are what? They are relevant. So now what is materiality? We are saying that information is what? Is material if its omission or misstatement could reasonably cause a distortion in the economic decisions made by the users. So if there's an information and then I omit it, the people will think differently. If I bring it to, they also think differently. If I do mistake with it too, they also think differently. Such information is material, and you must by all means what? Include it. That is it. Great. So that's the materiality. That is the materiality. I am done with the first, the fundamental. Now the question is, how do you then assess the maturity of the transaction? There are two ways of assessing the maturity. First, you can assess maturity by nature or by size. So let's start by size first. You look at the size of the size or quantum. The monetary size of the transaction. Let me give you a critical example. Critical one. If let's assume that a company, and then your annual service revenue is around something like this. There's a company that the annual sales revenue is dollars of $4,293, and it's in millions. You are reporting in millions. So these figures are in millions. Okay. That's your annual sales revenue. So it's 4.3 billion. That's your annual sales revenue. And there was someone there who managed to take away or stole $1,000. The person picked $1,000 the whole year. He managed to steal $1,000. Is it material? Looking at the size, the quantity, your sales is around 4.3 billion. So if I should write this thing in full, to be something like this: 4,293,123,123. And the person stole what? $1,000. So the person stole something like this, 1,000 like this. Is it material? It doesn't affect it, right? Great. So it is immaterial by size. What What if that person was a very stubborn guy, or was a qualified person, a trained thief, or a chartered thief, and then he was managed? He creates a fictitious account where every single minute, or even let's make it every single day, he was able to transfer $1,000 from the company's account to that fictitious account, and he was an accountant. So in a year, he wanted to get what? 365,000 US dollars. And this one is material. Oh yes, this one there now is material. Now they do not clap for you. The issue is this. We can also say that individually it might not be material, but aggregate. In aggregate, it might be what? Material. So that's why the auditors among us, we normally assess all the errors that we found in the financial statement in the course of the audit before we issue the audit opinion. Even if all of them, even if individually they are immaterial, we find the aggregate impact. If in total it will have a great impact, then it's material. Then they have to rectify and then correct all of the errors. I'm done with the fundamental principles. I will end at the enhancing section, and then we continue from there Wednesday. Now, I will start and end at the enhancing section. The enhancing section is not plenty. That one, there are 4, but they are very straightforward. So I'll use the remaining 4 minutes to clear them from the way. Thank you very much for meeting me up to this. So the enhancing. We said that there are 2 types of the qualitative features. We have the fundamental. There are 2. Relevance and effective representation. How we get it? Great. And all of them to have their ingredients. Enhancing. 1. Comparability. The financial statement must be what? Comparable, right? To the other entities' performance. So comparability means that the financial statement or the information that we are sending to them, it must be able to compare either to our own performance or to other entities' performance. So these are the options. So either you have to present maybe company A 2017, company A 2016, so that they can compare performance, right? If I send only company A 2017, it's devoid of what? Comparability. It lacks comparability. They can't compare. If I say 20 Ghana, and so, but if I say, okay, this year 20 Ghana, last year 18 cities, now you can compare that it has what? Increased by what? 2 cities. So performance has what? Improved. But if I told you this year 20 Ghana, would that give you last year's performance? No. That's why there's an adage that, so if I've not gone to everybody's farm, don't say that you are the best farmer. Or if I've not visited anybody's kitchen, don't say that you are the best chef. That's great. So option 1. Option 2. You prepare company A financial statement for 2017 and go and copy your best competitor for 2017 so that you compare. So if I give you the chance to choose one, which one are you going to choose? Assume that you are the accountant. You are preparing your financial statement. Are you prepared for this year and last year, or you prepare for our company this year and go and copy the competitor's own, add it to our financial statement and publish it? Which one will you do? Basically, you choose this one, right? This one is what you call trend analysis. This is intercompany comparison. Now, most companies do this, not most companies. Publication, they normally do this. They'll publish for 2 years for comparison purposes. Great. So that you avoid from any legal issues. Because if you go and do this, what if your competitor is doing better than you? You are selling your own self. You rather exposing yourself. Shareholders will take their money and go and invest in that company. What if you are doing better than that company? That means that company will tell you, okay, you want to laugh at us, So that's why you have copyright. They was just having legal issues against you, that you are like tarnishing their image in your financial statement because you feel like you are doing better than them. So normally companies prefer this one for internal analysis or internal benchmarking. I'm done. Now to enable comparability, there must be 2 things. to enable comparability, there must be two things. One, there must be what? Consistency or uniformity. Consistency or uniformity. To enable what? Comparability. Before you can compare well, there must be consistency in accounting policies. Today you are selecting this policy, tomorrow you are changing it. Today you are using this, tomorrow you are using that one. It will not let you compare well. Maybe 2017, the policy that you adopt is not the same as 2016. The basis are not the same. You can't compare. So if you want to compare very well, then keep the same principles over some period. Two, to enable comparability, there must be what? Disclosure. There must be what? Disclosure. Disclosure means tell us what has transpired. Now let me give you a classical example. Company A and company B. This is a profit made for the year. A is 50. Here is 30 cities. On the face like this, who is doing well? Preferably the one with the highest profit, right? Company A is doing better than company B, of course. But if I don't disclose, or if I don't tell you that, oh, company B made a huge investment during the year and therefore took away all their profit, and hoping that exactly 6 months from now, they will start recouping it 15 times of their investment. Now, who is doing well? In fact, this guy is doing far, far better. Far better. Have you seen? Even though his profit is lower. So disclosure. So if I don't tell you what happened, now, if I prepare 2017, let me even give you a classical example that you understand it. And you can cite it for the examiner. Let's assume that 2019 financial statement. Compare 2019 to 2020 financial statements. You realize that 2019 is very good. 2020 will be very poor. If we don't tell you, let us know somebody in which, don't know. If you don't tell that 2020 there was a pandemic that destroyed our business, that's why we had that loss. You tell us that 2020, we didn't like do well at all. Meanwhile, it's not our fault. Have you seen? So if you don't disclose, if you don't tell you what has happened, you may assume wrongly. You may assume wrongly, because if you just base on what you present is something that what has happened, and then we have presented it. If you don't tell you what has actually happened on the ground, you may assume wrongly. That is it. That's why I say stop judging, right? So that's why, like, if you see somebody doing something, just go close to the person. Let the person disclose you the mindset behind what he's doing before you make any decisions or any judgment. But if you base on what you see and make decision, you may sometimes end up making wrong decision because of what you see. What you see are not reality. Let them disclose the hidden ones. That's great. I'm done with comparability. Now let me move on to the next one. The second one is understandability. Understandability. The financial statement prepared must be easily be understood by the users. So if you prepare financial statement that the users don't understand, in some way. And for that matter, we are saying that the users must have a reasonable knowledge about the activities of the organization. They must have what? Reasonable knowledge. So if you have invested in mining company, please go and familiarize yourself with what? With how mining company prepare their financial statement, so that when they bring the financial statement to you, you won't find yourself wanting rather than understandability. The third one is verifiability. I like it very well. I'll tell you why I like it. Verifiability. Verifiability. I like it very well. I'll tell you why I like it. Verifiability. That means the financial statement that we have prepared, it must be easily be verified by a third party. Somebody should go through your financial statement. So if you're an accountant that you have prepared financial statement that nobody else can go through unless they call you on phone, Mr. Accountant, I can see 50,000 disclosed at the financial statement beneath it. What's the meaning of that? Can you tell me more? That means your financial statement lacks what? Verifiability. That's great. Now let me tell you why I like it. Now, we are saying that the financial statement must be verified by a third party, usually auditors, right? For examination purposes, your answer booklet, your answers that you're going to also provide must also be what? Be verified by what? A third party, usually what? The examiners. So if your answers, the examiners cannot verify and give you marks, then there's trouble and there's question. So that's the verifiability that we are talking about here. The last one is that the financial statement must be prepared on time. So timeliness. Good. It must not be too early nor too late. It must be on time. And then that's the end of the game. So these are the enhancing qualitative features. So today, at least we've done the up to the third content. Now the issue is this. The remaining parts of today's class down up to the regulatory framework has been done already in the video. So I'll upload and then send the video to you, and then you'll be fine. So kindly use the video to finish it up, and then we'll continue from the standards. So that is it. Great.